To keep yourself updated, subscribe to IndigoLearn and click the bell icon and download our app OneFin to start learning on the go.
Let's now understand the guidance given for service concession arrangement as a part of Appendix T to Ind AS 115. Now, before we get into the guidance, we need to understand what are these service concession arrangement, who gives this service concession arrangement, and how does it impact the revenue recognition. Now, if you look around, you would have seen highways being constructed, metro lines being laid down, bridges being constructed. Whose responsibility it is to provide all of these infrastructure? Obviously the government, central government or state government. They're supposed to provide us road, railways and all of those things, right? Now, many a times what happens is the government may not have sufficient funds to construct these infrastructure, to build this infrastructure. What does the government do? The government engages some private players. Now, say for example, in a particular city, a metro line has to be laid down and the government does not have the full amount of money to be spent on that metro line. So what does the government do? Government will invite for bids. They will select one particular player or maybe a couple of players and they will ask that player to build the metro line. Say for example, L&T is awarded the task to build a metro in a particular city. Now, when L&T builds the metro, L&T is spending money, L&T is constructing the metro line. Whose responsibility it is to pay to L&T? Because L&T is building on behalf of the government. It is government's responsibility to provide public service. But the government says, I don't have money. Government says, L&T, you please build. Now, when L&T starts building, L&T would say, where will I get the money from? If it goes back to the government, just now I told you, government does not have money. Then how will L&T earn money? How will L&T recover its cost? So, what the government says is, L&T, you build the metro. After you build the metro, after we test it, after we certify it as fit for operation, you operate the metro, say for example, for 30 years. So, for 30 years, you yourself operate the metro. And as you operate the metro, you collect fare from passengers, you collect rent from stalls at stations, you collect rent from, display hoardings, you do whatever you have to do. But for 30 years period, you can operate the metro. So, L&T can operate the metro during the period of this concession, and over the period of this concession, L&T would collect, say, fare from passengers. Now, the question is how the revenue would be accounted. That is first thing. Second, L&T has spent so much of money in building the metro line. Can L&T say that it is an item of property, plant and equipment? Because L&T is constructing a railway line, L&T is constructing a metro line. Is that metro line which is constructed with the stations and all of those things, is that a property, plant and equipment? Now, for something to be called a property, plant and equipment, it has to be in control of the entity. Can L&T control this particular railway line? Can L&T say that I will not operate this metro for 2 years? Can L&T say that I will allow only so many passengers, I will not allow more than so many passengers? All of those things are not within the control of L&T. L&T cannot direct the manner in which the metro has to be operated, because that would be governed by the contract between the government and L&T, and after the period is over, the ownership of the metro would be passed on to the government. So, the appendix clearly mentions that this infrastructure that is created, it cannot be recognized as a property, plant and equipment as per Ind AS 16. So, you cannot recognize it as a PPE. Then, how should we recognize or what should we do for the cost that we have incurred? Okay, that is one thing what we will be understanding. Second question that might come up is, L&T gets a right to use the land which is belonging to the government or which is owned by the government. See, when you put up a metro line, you are using the land given by the government to build the metro. So, L&T is actually having a right to use. Is this right to use covered under Ind AS 116? Can we say L&T has taken lease of land? We cannot say that, because again here, right to control is not with L&T, right to direct use is not with L&T. L&T cannot say that, for 6 months I will not operate the metro. It would be dependent on the government instructions. Okay, L&T on its own cannot increase the metro fares. Again, it has to consult with the government. So, L&T does not have any control. So, L&T does not have any control, and hence this is not covered under Ind AS 116. In fact, when we learnt about exceptions, the things which are not covered under Ind AS 116, this was one of the items where we said those contracts which are covered by Appendix D to Ind AS 115, those are not covered under Ind AS 116, right? So, that is one more thing that we will be understanding as to how will the accounting of that be done, right? So, that is what we will be understanding as a part of Ind AS 1. That is what we will be understanding as a part of this appendix. Now, I said there is a government and there is an entity. The government is called a grantor. The government has granted a concession to this entity, and this entity is called concessionaire. Now you might be wondering, sir, what is the concession given in this whole arrangement? Arey Baba, L&T has the right to build a metro without paying anything to the government, right? So that is the concession which is being provided. And the government says, you build the metro, operate the metro, or transfer the metro. Sometimes it may be a case where the government may say, you upgrade our infrastructure and operate the infrastructure and then ultimately transfer the infrastructure back to the government. Or there could be a public-private partnership kind of a structure. There can be multiple names. The underlying theme is, the government has granted a concession to an entity called the concessionaire. We are bothered about how we will account for various transactions in the books of the concessionaire. Now, the underlying theme of this public to private arrangements or this build, operate, transfer, the theme is public service. See, when L&T constructs a metro line, it is for public service. L&T is not doing charity from its pocket. Okay, there are ways in which L&T will earn revenue. In some cases, government may bear some part of the cost of the metro, but the whole theme is that this is done for public service. Highways being constructed, that is for public service, right? So this theme must be present in any service concession arrangement that we talk about. Let's now understand some of the features of this service concession arrangement. The first one is, we have already understood there has to be a public service obligation. Then the grantor that we are talking about, the one which grants this concession arrangement, is a public sector entity. That is central government or maybe a state government or a local authority, or sometimes a private player who has taken up these responsibilities from the government. Okay, so there has to be a grantor which is a public sector entity. Then the operator or the concessionaire has the responsibility of operating the infrastructure. It is not that they are just building it on behalf of the government. It is not that they have just built it and transferred it to the government. They also have a responsibility to operate the infrastructure. Then whatever prices this particular concessionaire or the operator charges from the end user, it would be a part of the agreement with the grantor and the concessionaire. So the original prices are decided, the formula to increase or decrease the prices are decided, the way in which the prices would be charged, they are also decided. It is not within the control of the operator alone to set the prices, right? So that is a very important thing that we must keep in mind. And lastly, at the end of the concession period, the concessionaire must transfer back this infrastructure to the grantor at a very nominal or maybe without any further consideration. So even if this particular concessionaire has spent all the money from its own pocket, and even if it has not recovered all the money from the prices that it has charged to the customers, even then the infrastructure will be transferred back to the grantor at the end of the concession period. So you would see in a lot of cases there are toll arrangements for 15 years, 25 years, 30 years, right? So after 30 years of collection of toll, then the operation of the road comes back to the government, and it is up to the government to decide whether they will continue to charge toll or they will make the road toll free, right? So as you cross across highways, as you use metro rail services, as you pass through expressways, do have a look at the name of the entity which has built the particular highway, which is collecting the toll on that particular highway, right? They'll give you a sense of understanding as to how these things actually work. So to summarize, in a nutshell, there is a grantor, that is a public sector entity or the government. There is a concessionaire, a private sector entity. There is a public to private arrangement. There is a public to private service concession arrangement under which the private entity will build and also operate the infrastructure. But the control is with the public sector entity. The control does not transfer to the private sector entity, and at the end of the concession period, the infrastructure is given back to the government. That is why we call it build, operate and transfer. So the private sector entity builds the infrastructure, it operates the infrastructure, and it transfers the infrastructure back to the public sector entity at the end of the service concession period. Now to apply Appendix D to Ind AS 115, two conditions must be satisfied. Okay, what are the two conditions? The appendix says, this appendix applies to public to private service concession arrangements. So there is a public to private service concession arrangements if, number one, the grantor, that is our government, controls or regulates what services the operator must provide with the infrastructure, to whom it must provide and at what price it must provide. So basically, along with the infrastructure, what are the various services that the operator will be providing, that is controlled by the grantor, and to whom the services will be provided, that is also controlled by the grantor. At what price the services will be provided, even that is controlled by the grantor. So that is the first part. And the grantor controls either through ownership, beneficial entitlement, or otherwise any significant residual interest in the infrastructure at the end of the term of the arrangement. So once the term of arrangement ends, the interest in the infrastructure, a significant residual interest in the infrastructure lies with whom? It lies with the grantor. It does not lie with the operator. Now, because this control is not there with the operator, that is the reason we don't recognize it as a property, plant and equipment under Ind AS 16. Now, the key question here is, how should the entity, that is our operator, which is L&T, account for the various transactions? See, the first thing is, L&T would be spending a lot of money to build the infrastructure. And we said, you cannot recognize that infrastructure as an item of property, plant and equipment. Then what is to be done for that? That is the first thing. Then second thing is, the government may give a lump sum consideration or payment to L&T for the construction work. Okay, and the government gives a right to L&T to collect fares from passengers, right? We call it user fee. So L&T has a right to collect fares from the passenger. What is to be done with that? So what the standard says is, the part of consideration where the grantor, that is the government, pays to the entity, that is our operator or the L&T, that is to be treated as a financial asset, because it is a receivable in the books of the entity, and the grantor has to pay that amount, and hence that is to be treated as a financial asset. Now, as far as right to collect user fees from the passengers are concerned, that has to be treated as an intangible asset. Now, why is that an intangible asset? That is an intangible asset because the entity, that is L&T, has got a right to collect charges from the users, okay, and that has to be treated as an intangible asset. Sir, how will we measure the intangible asset? Now, think about it. What are we doing? L&T is spending some money to create an asset. That asset is not an property, plant and equipment item, but an asset is being created. In exchange for that asset, see, that asset will ultimately be transferred to the government. In exchange of that asset, what does L&T get? L&T gets right to collect fees or collect fare from users, that is the passengers. So what is happening here? Now what is happening here? By transferring a non-monetary asset or by agreeing to transfer a non-monetary asset, the entity has got right to collect fees. So there is an exchange of asset to acquire an intangible asset. So that is how you have to understand. So when there is an arrangement like this, there could be one component which is a financial asset that the grantor would be paying to the entity or the operator, and there is another aspect where the entity gets a right to collect the fares from the passengers or from the users, that is to be considered as an intangible asset. And in cases where both of these are there, there is a consideration from the grantor and there is a right to collect the fees. In that case, you will account for an intangible asset as well as you will account for financial asset. When as far as financial asset is concerned, you will refer to the guidance given under Ind AS 105. When we come to that, we will understand it. Basically, accounting for it as a receivable. And as far as intangible assets are concerned, you will apply the guidance of Ind AS 38. Now, during the course of operations, the entity will be incurring liabilities, the entity will be carrying out, entity will have to incur expenses. How should we account for all of that? For all of that, you have to refer to guidance given under Ind AS 37, which deals with liabilities, right? So, three things we have understood. A consideration payable by the grantor to the entity, that will be a financial asset, of course, when some conditions are satisfied. Then, the entity has a right to collect user fees from the users, that is to be treated as intangible asset. And how will we arrive at the value? We will apply the principles of exchange of non-monetary asset, or maybe a combination of monetary and non-monetary asset if applicable. And lastly, the liabilities part where the entity has to incur expenses, that will be covered as provided under Ind AS 37. Now, when we talk about recognition of financial asset, what the standard says is, the operator shall recognize a financial asset to the extent that it has an unconditional contractual right to receive cash or another financial asset from or at the direction of the grantor for the construction services, and the grantor has little discretion to avoid the payment because the agreement is enforceable by law. So basically, what are we saying? If the entity has an unconditional right to receive the payment from the grantor, then that is to be treated as a financial asset. Now there could be some things like, there could be some cases like the government says you complete the project, you complete the construction activity, you finish the trial runs, then we will transfer, let us say 1000 crores, or we will pay you 1000 crores for construction services, right? So that part will be considered as a financial asset when the entity has an unconditional right to receive the payment, right? Then the standard also says that the operator shall recognize an intangible asset to the extent that it receives a right, that is a license, to charge users of the public service. Now, is this right an unconditional right to receive cash? Is this right an unconditional right to receive consideration? It is not an unconditional right. Why? Because only when someone uses the metro services, then the entity will get a right to receive the cash, right? So, in the second part, where the entity has a license or entity has a right to collect user fee, that is not an unconditional right. It is dependent on what? It is dependent on the user using the public service. Now the next question is, how will this entity recognize revenue? How will the operator recognize revenue? See, the operator is providing two services. One, construction service. Second, operation services. So, by applying principles of Ind AS 115, we will recognize revenue for the construction service and the operation service. And what the grantor gives as a consideration is one, lump sum payment or cash payment. And here the consideration that the grantor gives to the entity is one, a payment from the grantor itself, that is the first consideration, and second consideration is the right to collect user fee from the public. So two consideration or two types of considerations are given by the grantor to the entity, and that will be the transaction price, and you will apply the principles of Ind AS 115 to recognize revenue. And say for example, the grantor has agreed to pay a lump sum payment of 1000 crores, and that is a financial asset. How will the accounting of the financial asset be done? That will be done as per Ind AS 109. Let's say there is a right to use, let's say there is a right to collect user fee. What is that right to collect the user fee? It is an intangible asset. How will the accounting of that be done? You have to refer to Ind AS 38. Now our operator L&T may also not have all the funds with it to carry out the construction. So L&T goes out and borrow money from the bank. Now when L&T borrows money from the bank, where is it covered? It is covered under Ind AS 23 borrowing cost. What will we do with this borrowing cost? See, if there is an intangible asset that will be created and it is a qualifying asset, borrowing cost attributable to the qualifying asset will be capitalized. If there is no qualifying asset, if there is no intangible asset that is being created, then in that case the borrowing cost will be expensed, right? So you will need to apply principles under Ind AS 23 when it comes to borrowing costs. Now say for example, the government, to encourage the private players, says that along the metro line will give you few parcels of land which you can develop as maybe parking lots, which you can develop as maybe malls, and at the end of the concession period you can retain those malls with you, right? So we will give you a land parcel on which you can, let's say, construct a mall. Now the entity has received something from the grantor. Now will we say that the government has given a government grant here, or will we say that the land that has been given is a part of the consideration of the service concession arrangement? Now here what this appendix says is, and it's also obvious, that the land which is given for free is because of the service concession arrangement. It is not as a government grant. So such assets which are given by the grantor to the operator are outside the purview of Ind AS 20, and they should be considered as a part of the transaction price. So if L&T receives something for free, if L&T receives a parcel of land for free, that is not a government grant. You will not apply Ind AS 20, but you will apply the guidance given in Appendix D of Ind AS 115. Now to quickly summarize, when will we apply this appendix? We will apply this appendix in case of a public to private service concession arrangement, provided two conditions are satisfied. The first condition is that the grantor must control the services that will be provided, and second condition is that the grantor has significant beneficial interest in the residual infrastructure, right? If these two conditions are satisfied, both, not just one, both conditions are satisfied, then the public to private service concession arrangements are within the scope of Appendix D. Now sometimes what may happen is, the private player may acquire an infrastructure from another private player for the purpose of the service concession arrangement. Even such arrangements are covered under Appendix D. Or sometimes what may happen is the grantor may already have the infrastructure and that infrastructure is being transferred to the operator. Even in those cases, Appendix D guidance is applicable. Let's take few simple examples and understand how will we recognize revenue, how will we account for cost by applying Appendix D to Ind AS 115. Say for example, there is a concession arrangement, a service concession arrangement where there is a grantor and there is an entity and the term of the concession arrangement is say 10 years. Now under the terms of arrangement, the entity or the operator is expected to construct the road and operate the road. So let us note down some facts and calculate some numbers and see how will we account for those transactions. Say for example, say we have years here. So years 1 and years 2, there is a construction that has to be done or the entity will construct the road and the cost is expected to be 500. And normally when the entity charges consideration from the other customers or the fair value of the work that is done, it is say for this it is 5% higher margin 525 and here also it is 525. Okay. So in year 1 and year 2 what is happening? Construction. Construction work is happening in year 1 and year 2. Then after the road is constructed from year 3 to year 10, the entity will incur a cost of 10 crores per year to operate the road. Okay, assume all the amounts are in crores. So the entity will incur 10 crores to operate the road, and when we say operate, maybe maintenance of the regular maintenance of the road, then there could be a case of collection of tolls, paying staff to paying salary to the staff. All of these operational activities will cost 10 crores per year and this has a fair value of say 12 crores per year. Then in the 8th year there is an obligation to resurface. What is the meaning of resurface? See, after usage, the road would lose its quality and there would be a lot of potholes and all of that. You would have experienced that on Indian roads, right? So frequently the road has to be resurfaced. You have to remove the existing layer and you have to put down a new layer. And say at the end of the 8 years, there is an obligation. To relay the road, to resurface the road, that will cost 100 crores to the entity and normally this has a fair value of 110. These are the initial estimates of the contract. Now, who is the service provider? Entity is the service provider. What are the services that the entity is providing? Services being provided or performance obligation, construction, then operation, then resurfacing. Right. So these are the three services which are being provided by the entity to the grantor. Okay. Under the terms of the arrangement, for these services being provided, what the grantor does is grantor pays a consideration of 200 crores per year from year 3 to year 10. So basically from the 3rd year onwards till the 10th year, the consideration that will be paid is 200 per year and this consideration includes the cost of construction, the cost of operation and the resurfacing cost as well, right? Now with this understanding, let us see how will the revenue be recognized, then what do we do with the various transaction costs, right? And how do we recognize revenue? And because the timing of collection of consideration is different from the timing of performance obligation, there is also an interest component. What do I mean by that? Basically, these two are incurred in year 1 and year 2, 500 each. Okay. When will we receive the payment for this? 3rd year onwards till the 10th year. It is included in that. So, if it is included in that, there is definitely a significant financing component which has to be segregated. Then there is also this one-time activity of 100 crores which will be incurred in the 8th year. Now, how do we treat this 100 crores, right? When do we recognize the cost of this 100 crores and how do we recognize revenue for that? That also we need to understand. Now, first thing first, we have to check what is the financing component involved in this entire transaction. If you see, let me just note down. And friends, this is a very comprehensive example for your understanding purpose. Most of the information in these kind of questions will be given to you in the examination. You will not be required to make complex calculations, okay? But the reason why I am taking you through this example is for you to understand how is the Appendix D given as a part of Ind AS 115 applied in real life scenarios. In fact, this example I have taken from Ind AS 11, the earlier accounting standard on contracts. From that I have taken this example. The example is still relevant, the standard is not applicable, but the example is relevant, so I have taken it from there. Okay. So we have years 1, 2, 3, 4, 5, 6, 7, 8, 9 and 10, and for simplicity purpose we will assume that all inflows and outflows happen at the end of the years. Okay. Now coming to years 1 to 10, one part is the cost that the entity is incurring, that is one aspect. The other thing is the revenue or the amount that it should have received from the other party, that is the grantor. So what I am trying to say here is, in year 1 I incurred a cost of 500. Against that 500 I was supposed to get a revenue of 525, correct? Did I get a revenue of 525? Did I collect the amount of 525? No, I did not collect. When will I collect that? I will collect that later in installments starting from year 3. So basically I was supposed to collect 525 at the end of year 1, 525 at the end of year 2. From year 3 onwards, what am I supposed to collect? I am supposed to collect this 12 crores per year, the fair value of operation service. I am supposed to collect that. So I have to collect 12 here, 12 here, 12 here, 12 here, 12 here. In the 8th year, I am carrying out a resurface. When I say I, the entity is carrying out a resurfacing activity for which 110 is collectible. 110 and another 12. So 110 plus 12, 122 is collectible in year 8. So this is operation plus resurfacing. Okay. Then in the 9th year again 12 is to be collected, in the 10th year again 12 is to be collected. When I say to collect, this means due. These are the amounts due at the end of each year for respective years from year 1 to year 10. The grantor is supposed to pay these amounts to the entity. But when did the payment start? Inflows or the payments started in year 3, 200 here per year till the end of the 10th year, that is 1600, which is collected. Now, what is the net cash flow? I was supposed to receive 525, but I received 0. So there is a shortfall of 525. So what will I do is inflows minus expected, 525 is the shortfall. Here also 525 is the shortfall. Now you may say, sir, there is no cash outflow of 525. Cash outflow is only 500. What you need to understand is, if I compare 500 of cost and 200 of revenue, that will give me the total return from the project. But what I am trying to compare is, the government was supposed to pay me 525, but the government is paying me delayed. The government is paying me after 3rd year. What is the implied interest component in this particular transaction? So to understand this, let me give you a very simple example. Say the cost of production for me is 500. The normal price at which I will sell to outsiders is 525. I sold to you at 600. Sir, why are you charging me extra? Because you will pay me after 3 years. So 500 is my normal cost. 525 is my normal selling price, but I will charge 600 from you because you will pay me after 3 years. Now in this, what is the financing component? Will you say 600 minus 500 entirely is the financing component, or will you say I am supposed to pay 525, I am paying 600, so 75 is financing component, right? So that is how I am considering this 525 to be a notional outflow. I am giving services worth 525 to the grantor. The entity is giving services worth 525 to the grantor, but not receiving any amount. So like this, the net cash flow is 525, 525, 188, 188. Now see, from here it starts becoming positive, okay, 188. So this is the net cash flow. If I calculate the IRR of this net cash flow, which will come to 6.18%. So basically, these were the amount due. This is the payment pattern. This results in an IRR of 6.18%. If I increase the decimals one more, 6.179% or 6.18%, okay, rounding off differences. Now what does this mean? This means that in the pattern of payment by the grantor, 6.18% interest is implied. So there will be a finance income of 6.18%. So let us build the table for finance income. Again friends, this is purely for your understanding of how things flow. Such kind of complex questions will not be tested in the examination. Even if they test, they will give you numbers very clearly. Okay. So let us build the table. Now one more thing before I build the table. Will this arrangement result in a financial asset or an intangible asset? Will it result in a financial asset or an intangible asset? When I say it has to be a financial asset, then there has to be an unconditional right to payment. The entity can demand for payment from the grantor. So there is a financial asset in this because the grantor is paying 200 per year. If this 200 per year was to be collected from the users, then it would be an intangible asset. Okay. So let's now see how this interest calculation actually works and what will be the amount of revenue that the entity will be recognizing. Okay. Years. So you have 10 years. Okay. Opening balance each year. Revenue. Receipts. You will get some receipts. Balance for interest and interest. Okay. What is the opening balance? Opening balance is 0. How much is revenue that you will recognize for year 1? Revenue for year 1 we calculated the fair value 525. Okay. Then receipts. Are there any receipts in year 1? 0 receipts. How much is the amount on which you will charge interest? See, revenue you have recognized at the end of year 1. So will there be any interest on that? There will not be any interest. So no interest will be applicable. So as far as interest is concerned, there is nothing for interest. Interest will be 0 multiplied by 6.179%, which is 0. Now, what will be the opening balance at the beginning of year 1? 0 plus revenue 525 minus receipts if any plus interest, you get 525. So basically, this will be opening balance plus revenue that you recognize minus any receipts plus interest, you will get opening balance 525. In year 2, how much is the revenue? In year 2, the revenue that will be recognized is 525. Okay. How much is the receipts? In year 2, are there any receipts? Will the grantor pay something to us? Grantor will not pay anything to us. So, year 2 also no receipts, 0. How much is the balance for interest? Now, opening balance was 525. So, on this opening balance, you will charge interest. How much is the balance for interest? Opening balance is 525. On this amount, you will be charging interest, right? How much will be the interest? How much will be the interest? 525 multiplied by 6.17, 32.44. Come to year 3, opening balance is opening balance for the previous period plus revenue minus receipts plus interest, you get 1082.44. How much is the revenue recognized? 12. Why? Because now we have started operating the road. Are there any receipts? Yes, 200 is the receipt. What is the balance for interest? Balance for interest is your opening balance because other cash flows are happening towards the end. And how much is the interest? Interest is 66.89. What is the opening balance in the next period? Opening balance 1082 plus revenue plus receipts. So, I'll just make this symbol correction here. Minus receipts plus interest, you get 961. So, when you say 961, how much is the revenue? 12, receipts 200, balance for interest 961, interest income 59.4. Like this, if you do for 10 years, so if you do for 10 years, you get this table. So, just to populate the balance, let me pull it out here, it becomes 0. So, basically if you see in year 1, you recognize revenue of 525, no interest recognized. In year 2, you recognize revenue of 525 and on that, on the opening balance, you recognized interest of 32.44 here. Then, in the third year, this is the opening balance. On this, you recognized interest at 66.89 and you also recognized an inflow of 200. When there is an inflow, the balance reduces. When there is an inflow, the balance reduces. Like this, when you prepare the table for the entire period, you see the ending balance comes to 0. The ending balance comes to 0. Now, this table I have prepared for you just to demonstrate how the cash flows work. Now, here the thing that you need to keep in mind is this interest component will be recognized as finance income. And this is the revenue that we will be recognizing over the period of 10 years. Sir, we did not use here we did not calculate percentage of performance obligation and all of that. See, even if you would have done that, basically the sum of all of this if you do and then start allocating it on the basis of 525, 12, you will get the same revenue. Okay. So, there is no point or no fun in doing this total revenue expected of 1256 and again allocating them in the ratio of this. Okay, it will give you the same output. So, that is why you need not do the exercise all over again, right. Now, so far what we have understood, I am just quickly recapping so that we don't lose track. There is a contract where the cost that will be incurred, construction cost in year 1 and year 2, 500. The fair value of that construction cost that is normally charged or the transaction price is 525. Then from years 3 to 10, there is a operational cost that is 10 for which the fair value is 12 and in the 8th year, there is a cost of 100 for resurfacing the road for which the fair value is 110. Now, when you consider all of these and see the payment pattern, you get an effective interest rate of 6.179 or 6.18. This will be given to you in the examination, or you can do an IRR method and calculate. I don't expect institute to test you at this level on how to calculate IRR. They should simply give you the IRR and check whether you can apply the IRR correctly or not. Then, considering 6.18%, we plotted or we created an amortization schedule. If you are somewhat confused out here, no need to worry, you can revisit the video, and when we come to Ind AS 109, we'll have a lot of these kind of problems. So, you'll be absolutely comfortable, right? So, here opening balance at the beginning of year 1 is 0, revenue recognized 525, no receipts, no interest, closing balance is 0, closing balance is 525. In the second year, interest you provide on the opening balance. So, whatever is the opening balance 525, on that you have provided interest. Like this, you keep on providing interest for different years, and when you start receiving the payment, and ultimately the closing balance will become 0. Let's now prepare a P&L and see how these amounts would be reflected. And one more thing, friends, here there is a case of a financial asset. You are not recognizing an intangible asset, but you are recognizing a financial asset. Now, when you recognize a financial asset, whenever you recognize revenue, you will debit a financial asset and credit revenue. As simple as that. And whenever you charge interest, again debit financial asset and credit revenue, credit income. And when you receive money, you debit bank and credit financial asset. A simple debtors accounting is that you need to understand, right? So, coming to P&L, revenue, okay, so let's say year 1, 2, 9, 10, okay, revenue. What is the revenue? Revenue we have already calculated here. Same revenue you need to plot. 525, 525, so on till this. So, I have Excel, you have to do it manually, okay. So, there is something called values, and you just put a transpose. So, you get revenue plotted, okay. Don't worry, your life will also be simple once you become a chartered accountant, once you start working, right. There you don't need to do a manual calculation. And I strongly believe we should have a computer based examination, at least for subjects like SFM, subjects like FR, costing, where there are a lot of calculations involved, and when you do on pen and paper, some mistake here, some mistake there, and the entire problem gets screwed up. So, we have plotted the revenues. Then coming to cost, okay, how much is cost? First year 500, let me put it in negative numbers, 500, 500, then 10, already given in the question, right, 10 or in our example actually. Then 110 here, again 10 here, and again 10 here, okay. So, these are the costs that will be recognized. Then, is this all or is there something else? There is finance income. What is the finance income? Now, for finance income, again, we have calculated it here. In year 1, we do not have any finance income, so 0. In year 2, it is 32.44. Then, in year 3, it is 66.89, 59.40, I will copy it again. So, this is the finance income. Then, what is the net profit? Net profit is 25, 57.44. Now, 25 in the first year is straightforward, 500 of cost, 525 of revenue. In the second year, 525 of cost, 525 of revenue, 500 of cost, and 32.44 of finance income. So, you get net profit. Like this, if you do, you get the net profit for each of the year. So, if you do a total here actually, or let me add one more line, profit from contract or SCA, service concession arrangement, is 525 minus 500, 25, and so on and so forth. You can calculate for each of the years. 25, 25, 2, 2, 2, 2, 2, 12, 2 and 2. Okay. Now, what does this represent? This represents the normal profit margin. This represents the normal profit margin as given in the question. If I do a total here, 1256 is the total revenue, 1180 is the total cost, 76 is the total profit, 344 is the total finance income, and 496 is the total profit. So, basically this 496, the total net profit, comprises of 76 from the service concession arrangement directly and 344 as the finance income. Now, if you want to come back and see here, the total of interest income is 344. The total of revenue, the total of inflows is 1600. Now, what does that inflow signify? If you see total inflow, 1256 revenue plus 344 interest, 1600 is the total inflow. Total cost 1180 is the outflow. Net inflow is 1600 minus 1180, 420. So, here also if you see what we did initially, net inflow. Then if you want to see the net inflow, this is the total inflow 1600, and from this you can calculate the total outflow, which you have already done, and based on that you can calculate the net balance, right? So, basically to summarize, in cases where there is a financial asset, you will recognize revenue. Revenue will be based on the principles of Ind AS 115. You will allocate the revenue to the different performance obligation on the basis of their relative standalone price. Now, here the relative standalone prices are the fair value itself. Based on that, you will allocate the revenue. And then if there is a financing component involved, you will recognize income on the financing part separately. And based on that, you can calculate what is the net profit. It is very straight. So, looks like the formula got updated because I inserted a row here. So, let me just change this. Is this plus this 25, 420. So, just to quickly recap, revenue based on the fair values, cost as per cost incurred, and finance income because there is a deferred consideration. Why the consideration is deferred? You have completed the performance obligation, but payment is being received later, right? So, this 525 shows the revenue from construction service, 12 shows revenue from operations, and 122 shows revenue from operations, that is operating the road and resurfacing, and this is how we can reconcile, right? So, on the reconciliation, total revenue minus cost will give you total profit from contract, plus add interest, you will get total profit of 420. Total inflow is 1600, total cost outflow is 1180, so the net inflow is also 420. So, this 420 and 420 is also matched. Somewhere in between, when I inserted this row, the formula got updated and maybe you would be seeing the different numbers here. Don't worry, this is the correct picture, right? So, here if you understand, we have recognized a financial asset, that is a receivable, right? As and when we recognize revenue, this 525, right? This represents a financial asset. So, this is the balance of financial asset. We have recognized interest because there is a financial asset involved. Now, friends, in the example that we just took, we saw how do we account for service concession arrangement. We understood what are the costs involved, how do we calculate revenue, and how do we calculate implied rate of return or implicit or internal rate of return, and based on that, how do we account for finance income. So, basically, we had the cost elements here, we had the fair value, that is the revenue element there. So, these were the amounts of revenue that would be recognized, and because inflows were at a different timing, we calculated implicit rate of return or internal rate of return. This I told you will be given to you in the question. Based on that, we calculated the interest amount to be recognized, and in the P&L, we recognized revenue, we recognized cost, and then we recognized what is the profit from this, then we recognized the finance income and the net profit, and ultimately we saw, the net profit was 420 based on both the profit from the contract as well as the interest income, and also that matches with the net inflow. Now, this was a case where the grantor is making or paying some consideration to the operator. Now, let us modify this example slightly and assume that instead of grantor paying the consideration, the entity has a right to collect user fees from the users. From vehicles who pass on that road, who use that road, the entity or the operator has a right to collect a toll fee, a right to collect a user fee. Now, whenever an entity gets a right to collect a user fee, at that point of time, intangible asset comes into picture. Let us see how these things would change. Let us see what will be the impact on the profit and how will we present different items in that situation. Okay. So, I am changing this example slightly. Consideration now is not paid by the grantor. Here I am making a change. The entity has a right to charge fee from users. Now, when will the fee be charged from users? Fee will be charged from the users based on usage, okay, based on usage. So, on the basis of usage, the entity will collect user fee from the users of the toll road, and say for a moment that the entity expects to collect 200 crores per year every year. So, collection is 200 crores. So, even here the collection does not change, but what has changed? Your customer has changed. Now, the grantor is not paying you consideration. Who will pay you the consideration? The user will pay you the consideration. The user who uses the road, that person will pay you the consideration. That is the first change. And second change is, here we said there was an obligation to resurface. That is, whether or not the usage happens, whether or not the wear and tear happens, there was an obligation on the entity to recarpet or resurface the road at the end of 8 years, and we treated that as a separate performance obligation. That is why in the 8th year, if you see, in the 8th year we recognized full revenue and cost related to that because it was treated to be a separate performance obligation. In this example, we will modify it slightly. Here we will not say at the end of 8 years, here resurfacing is as and when needed. Okay. So, we will change this example slightly and here we will say resurfacing as needed. So, on need basis, resurfacing needs to be done, but the entity expects that the resurfacing liability or obligation will occur in the 8th year. So, 8th year is the entity's expectation. 8th year is the expectation that the resurfacing liability would arise. Now, the entity expects that in the 8th year, the entity will have to resurface the road. In the earlier case, we said whether or not wear and tear happens, you will have to resurface the road, and hence it was a separate performance obligation. Here, is it a separate performance obligation? It is not a separate performance obligation. It is a part of your routine repair work, but the entity expects that it will carry out the repair work in the 8th year. Now, in the 8th year, when 100 of cost will be incurred, is it only pertaining to the 8th year? We have to go back and check in AS 37 requirement of creating liabilities. See, the road usage starts in year 3. From year 3 to year 8, the road will be used. Because the road is being used for those years, the resurfacing liability arises. Hence, you cannot just say that it is a liability pertaining to the 8th year. You will have to start providing for the liability right from year 3. So, this 100 is a future value of the obligation. We will have to arrive at the present value for each of the years, charge interest or add interest cost to that, what we call as unwinding of discount, and at the end of the 8th year, whatever is the value, that will be the liability which will stand in the books to settle the amount that has to be paid for resurfacing, and this 100 will be apportioned over year 3 to year 8 because that is the period over which the repairs obligation arise. Ultimately, you will carry out the repair in the 8th year. So, India's 37 provisions would be applicable and you will split the liability over the years. Now, what over the years, that is year 3 to year 8. Now, what if I tell you that this is a separate performance obligation, that resurfacing, even in this case, it is decided that in the 8th year it has to be done. In that case, whatever treatment we did in the earlier example, the same treatment would follow. Okay. Now, for that, whenever you incur the cost of 100, in that year you will be accounting for it, that is in year 8. But here we are assuming that there is no fixed year in which this work has to be done, but it is entity's expectation that the entity will carry out the work in the 8th year, right? So, resurfacing obligation is 100, which we have to apportion between year 3. So, these are the years, I will just put it in different colors. These are the years over which you will need to provide for the performance obligation and add interest to that. So, resurfacing obligation, let us assume for the 8th year amount attributable is 17 and it is less by 1 rupee each year, 15, 14, 13 and 12. How did you get this? This is just taken from the example where they said this is the pattern in which the liability has to be created. Okay. And discounting factor, %6%. So, what will be the interest portion? In the first year, because you are providing it at the end of the year, there is no interest. So, closing balance will be 12 plus 0, which is 12. Okay. Then, in the next year, you will have to provide interest on the closing balance lying at the end of the previous period, that is 12 multiplied by 6%, you get 0.72. Now, looking at the closing balance, so opening balance was 12 plus 13 for the current year obligation and 0.72 interest, closing balance is 25.72. On this 25.72, you have to calculate 6% interest and the closing balance will be 41. So, basically 25 plus 14 plus 1.45, let me make it in 2 digits. Okay. Then interest here is 2.48, closing balance is 58.74, 3.52, 78.26, 4.70, 99.96. Okay, so this is the breakup of 100. So basically, by providing 12, 13, 14 each year and adding interest to that, you get the ending balance as 100. So what is the cost for each year? Cost for each year to be provided is the obligation, the liability portion plus the interest portion, that is 12, and for each year, just if you add it, you get for each year what is the expense to be provided. Now here what are we doing? As compared to the previous example, if you see here, the entire 100 of cost was included in 8th year because it was a separate performance obligation satisfied in the 8th year. In the next case, it is not a separate performance obligation. So these are the expenses which you will provide every year in line with Ind AS 37. Sir, how will we know whether it is a separate performance obligation or not? It will be given in the question, or based on the facts you have to make a judgment, right? If the question says that it is a separate performance obligation, entire cost will be attributable in the year in which that performance obligation is satisfied. Once we have identified the resurface obligation, we have to come back to the P&L and prepare the P&L. Now, while preparing P&L, we have to identify what is the revenue that has to be recognized every year. Now, just to refresh the example, the entity is providing a construction service and the entity is also providing a service to operate the toll road, right? Along with the operation, repairs and maintenance are also included. Now, look at it from the point of view of the entity. For whom is the entity carrying out the construction activity? The entity is carrying out the construction activity for the government or for the grantor, right? Because the entity, once it has constructed the road and operates it, will transfer it back to the grantor at the end of the 10th year. Now, this road which has been constructed, it is not an item of PPE for the operator. It is an asset which is being created for the grantor, and the control also lies with the grantor, right? That is why entity will not recognize any item of PPE. Now, if you see the fair value of construction services, the question mentioned that it is 525 and 525. So basically, in 2 years, 525 plus 525, 1050 worth of construction service is being provided, right? Now, once this construction service is completed, that is, the entity has incurred 1000 of cost, entity believes that the fair value of the consideration is 1050. Is the grantor paying 1050 to the entity? The grantor is not paying anything. What is the grantor giving in return? The grantor is giving a non-monetary asset in return. What is the non-monetary asset? Right to collect user fees. This is very important for you to understand that here the operator, after having constructed the asset, is handing over the control to the grantor. The operator will operate the road, but the control is with the grantor. The transfer of control has happened. Now, when the transfer of control has happened, what is the consideration received in return? The consideration that is received in return is right to charge user fee and intangible asset. So, the control is given to the grantor, intangible asset comes into the book. Now, at what value will we recognize intangible asset? We have understood. When there is a non-monetary consideration involved, then revenue will be recognized at the fair value of the consideration. So, the intangible asset will also be valued at the fair value of consideration, that is 1050, 525 plus 525. Or if you think at it the other way, the asset that is being given up, that is the constructed road, the control over constructed road has a fair value of 1050. So, consider that as the value which is being given up, and intangible asset worth 1050 has been received, right? The first priority is fair value of asset given up, or the other way to understand it is, in case of revenue recognition, when there is a non-monetary consideration, you will account for revenue at fair value. So, what happens here is, the entity basically gets an intangible asset. What is the intangible asset? Right to collect fee worth how much? 1050. Okay, and revenue is recognized at 1050. Okay, so 1050 of revenue recognized, 525 and 1050 of intangible asset is received. So, when you come to this statement, revenue at 525, revenue at 525, and cost incurred is 500. See, you have incurred a cost of 500 to get an asset worth 525. So, that is the cost recognized. This is the profit. And coming to finance income, I will come to the discussion slightly later. Let me first finish the top level revenue items from year 3 to year 8. Okay. Now, your dealing with the grantor is over. Whatever you have to give to the grantor, you have given. The grantor has given a right to use. The grantor has given a right to collect user fee, and you now hold the intangible asset. Now, what will you do with this intangible asset? Using this intangible asset, you will start collecting user fee from the users. That is, whoever passes through the toll, you will start collecting toll from the user. Now, when you are collecting toll from the user, what is the revenue that you should recognize? Now, please note, with the entity, there was a grantor as a customer. That transaction is over. Now, with this entity, we have another party, an end user, which is also a customer. Now, what are we obliged to provide to the customer? Customer has a right to use the road. For using the road, customer is paying us money. Customer is paying us the user fee. So, there is a performance obligation to provide access to the road, to provide the road in a good condition. Users are using the road. As and when the performance obligation is satisfied, the entity is also collecting money. So, the moment a user passes a toll road, the user pays a toll fee. These days it is automated itself, and in respect of that, there is a performance obligation, and that is being satisfied because the user has already used the road, right? So, here there is a separate performance obligation. There is a separate contract with the end users. And as and when the user pays us the toll fee, the entity will be recognizing the revenue. So, in a year, 200 crores of toll is being collected, the entire 200 is revenue. Then, sir, what is the cost of providing that service? We got that intangible asset, right? You will start amortizing that. So, 1050 worth of intangible asset amortized over a period of year 3 to year 10, that is 8 years. Every year you will amortize that. Against that, you will recognize revenue of 200. Sir, what do we do with the resurfacing cost? Resurfacing cost will also be provided every year on the basis of the calculation we have done. There is no separate revenue that we are getting for that. What we are getting is the user toll fee 200 every year from year 3 to year 10. So, one thing that you need to understand, in case of an intangible asset, the entity has a separate contract with the government and the entity has a separate contract with the end users. When the entity has a contract with the government, entity transfers the constructed asset or the contract asset, and the entity receives intangible asset in return. And when the entity receives intangible asset in return, using that intangible asset, the entity is able to collect user fee. As and when a user passes through the toll, entity collects amount, so that becomes a revenue as far as the entity is concerned. So, coming to the P&L, first year revenue is 525, third year onwards revenue is 200, okay. Then, cost we have seen 500, then provision for resurfacing from year 3 onwards including interest is 12. Here you have calculated, so that you can plot it. I will put it minus 12. Okay. Then, is there any finance income element here? Now, here friends, please note, the consideration that is being received from the user is for the services being provided to the user. As and when the users access the road, users pay. So, there is no difference, there is no timing difference involved here, and hence there is no significant financing component. And as far as the intangible asset is concerned, there is no cash component which is flowing into it. So, even there is no significant financing component, right. So, this finance income is not needed and the net profit is also not needed. Now, if you see each year, first year, now if you see each year 525 minus 500, 25 is the profit, 525 minus 500, 25 is the profit. This is the profit from construction activity, okay. Then, and please note friends, I pass this entry intangible asset to revenue. In the first year actually will be contract asset to revenue, 525, 525. This you will do for 2 years. Then you will have intangible asset right to collect fee, which is 1050 to contract asset 1050, okay. And please note here, the entity does not have unconditional right to receive payment from the grantor. The entity has a right to collect the user fee only when the user uses the road. And also please note friends, there is no unconditional right when the construction services are completed, because user will make the fee payment only when the user uses the road. If the user does not use the road, if there are no passengers, if there are no vehicles, then there is no revenue at all, right. So, this is what one more thing you have to remember. Now, comparing revenue 525, 525, after that 200 each year, and cost we have incurred, provision for restructuring we have captured. One more thing that we need to do is amortization. Amortization of what? See, 1050 worth of intangible asset is there, right? Using that, you are collecting the user fee. So that has to be amortized, that has to be expensed. How will we expense that? Principles of Ind AS 38 on a straight line basis, unless you have some other better presentation. 1050 by 8, you have 131.25. Let me put it in minus, negative number. 131.25, 3, 4, 5, 6, 7, 8, 9 till 10 years. And let me update the profit column also. 25 here. So 46.75, 45, 43, 41, 40. Here there is a loss, sorry. This has to also be minus 10. 37, 58 and 58. That is the profit that is being recognized. And if you see the total profit is 420. Is it not the same earlier? Earlier also it is the same 420. But one thing that you need to keep in mind is, friends, here revenue recognized was only 1256. Here revenue recognized is 2650. Why 2650? Because the contract asset is being transferred to the government against which we have received an intangible. So for construction service, separate revenue is being recognized, and whatever is being collected from the users as toll fee, a separate revenue is recognized for that. Now you might find this complicating or overwhelming. Please note, this kind of difficulty levels will not be tested in the exams, but I thought you should know the flow of transactions so that you can understand the questions that are given in the examination. In fact, now I will be taking up a question from the study material. If you look at the study material, you just need to apply the principles. So much of calculations are not needed. You just need to apply the principles and give an answer to the question. Let's have a look at a question from the study material which is based on service concession arrangement. A Limited is in the business of infrastructure and has two divisions, toll roads and wind power. There are two divisions, okay. The brief details of these businesses and underlying project details are as follows. Number 1, Bhilwara Jabalpur toll project. So, toll project between two cities. The company has commenced the construction of the project in the current year. So, current year is when the project construction has started, and has incurred total expenses aggregating to rupees 50 crore as on 31st December of year 1. Under IGAP, the company has recorded such expenses as intangible asset in the books of account. The brief details of the concession agreement are as follows. So, the details of the concession agreements are given. We will see whether intangible asset is applicable or not applicable. They said under IGAP they have considered it as intangible asset. IGAP meaning the earlier accounting standards, okay. Total expenses estimated to be incurred on the project is rupees 100 crores. Fair value of the construction services is 110 crores. Okay, so total expected cost is 100 crores and the fair value is 110 crores. Total cash flow guaranteed by the government under the concession agreement is 200 crores. So, what the government has told is the total cash flow that the entity will receive will be 200 crores. Finance revenue over the period of operation phase is 15 crore. What is this finance revenue? Now, this 200 crores of cash flow may not be available immediately. They may be available at different points in time, and because of which there is a financing component, and it says finance revenue for the operation phase is 15 crores. Other income relates to the service provided during the operation phase. So, basically entity will receive 200 crores. Okay. Out of this 200 crores, 110 crore is your fair value of construction service, that is what when the road is being constructed, and finance revenue over the period is rupees 15 crores. So, 110 plus 15, 110 is for construction service, 15 is for finance. So, 125, which means balance 75 crores is for operations, that is when the entity operates the road, the revenue attributable to that is 75 crores. Okay, then second one is a Kolhapur-Nagpur expressway to two cities in Maharashtra. The company has also entered into another concession agreement with the government of Maharashtra in the current year. The construction cost for the said project will be 110 crores. Fair value of construction cost is 200 crores, means the company will incur cost of 110 crores, and the fair value if it has to charge from the customer is 200 crores. The said concession agreement is a toll based project and the company needs to collect the toll from the users of the expressway. Under IGAP, UK Limited has recorded the expenses incurred on the same said project as an intangible asset. So, here also intangible asset and here also intangible asset. It is not UK Limited, it has to be A Limited. Okay, so I also did not read the question fully before typing here A Limited. Okay, now What would be the application classification of Bhilwara-Jabalpur toll project as per the applicable Ind AS? Give brief reasoning. Then, what would be the classification of Kolhapur-Nagpur Expressway? Give, as per Ind AS, give brief reasoning. And suitable accounting treatment for the preparation of financial statements as per Ind AS for both the projects. So, basically, in these two projects, we have to identify in which project will we have a financial asset and in which project will we have a intangible and intangible asset, and we have to give accounting treatment, basically the journal entries for both the projects. So, in this question, basically we have to see what will be the classification of Bhilwara-Jabalpur toll project as per the Ind AS, right? So, as per Ind AS means Ind AS 115 and reasoning for that. Now, if you come to Bhilwara-Jabalpur toll project, here who is paying the consideration to the operator? Are the users paying the consideration, or is the grantor or the government paying the consideration? It says the cash flow guaranteed by the government under the concession agreement is 200 crores. So, it is the government who is paying or who is guaranteeing the payment of 200 crores to the entity. Means what? It will be a financial asset because the entity has an unconditional right to receive payment from the grantor. And can the grantor avoid the payment? Can the grantor avoid the consideration? It cannot, because under law the contract would be enforceable and the entity has all the right to demand the payment from the government, and hence there is a financial asset which has to be recognized, that is a receivable which will be recognized. Now, what will be the receivable amount for? Now, see, there are different components. One, fair value of construction service. For fair value of construction service 110 crores, you will recognize a receivable and corresponding revenue. Then, finance revenue over the period of operation phase. So, over the operation phase, whatever is the finance income or finance revenue, that will be considered as your finance income, that will be recognized separately. And whatever is the balance left, that is 75 crores, 75 crores will be revenue from operations which will be recognized separately, right? So, basically on construction service, we have to recognize revenue. What is the revenue? 110 crores. That is the fair value. Okay, because that is the fair value of the work being carried out. That is the portion which is attributable to construction service. So, financial asset which is a receivable, debit 110 crores to revenue 110 crores, right? So, this is on the construction service. Say for example, the construction is completed over a 2-year period, then accordingly based on the value of output completed, based on that ratio, or if that is not available based on the input ratio, you will allocate the revenue, right? That is the first part. Then coming to finance income, right? On finance income, debit the financial asset by how much? 15, and credit what? To finance income or interest income 15 crores. Okay. Then the last one, on operating the toll road, there is a revenue to be recognized. How much is the revenue? 75. How did we get 75? Basically 200 minus 110 minus 15 is what is 75. So, you will debit the financial asset by 75 and you will credit the revenue by 75. And when you receive the amount, bank account debit to financial asset which is the receivable, how much? 200, right? Simple way of accounting. We have already seen a detailed computation in the previous examples that we took. This is more of a simple presentation and judgment related question where you have to decide whether there will be a financial asset or an intangible asset, and what and how will you recognize various aspects in the books. Now, you may get a doubt as to when should we recognize this revenue on construction service? Over the construction period. When should we recognize this finance income? Over the period of finance, right? So, over the period when you receive the money, over that period you will allocate it by preparing an amortization schedule as we have done in the previous example. Then, on operating the toll road, based on the value of services provided for the operations, right? So, when you are operating the toll road, what is the fair value of service provided? Based on that, you can recognize the revenue, and when you receive the amount, whenever you receive the amount over that period, you will recognize the revenue. This is the first part. Coming to the second part, and yes, of course, the cost that is being incurred. I think the question also mentions about the cost. The question says has incurred a total expenses of aggregating to 50 crores as on December 31st and they have recorded such expense as an intangible asset. So you cannot record it as an intangible asset, that is the first thing, and 50 crores is the total cost, so that also you need to account for it. So whenever you incur the cost, you would say construction cost debit to bank 50 crores. Okay, over the period of construction. So as you incur the construction cost, you will debit the amount to the construction cost and you will credit bank. Okay, how much of this will go to the P&L would depend on what is the stage of completion. Right, now coming to the second part, Kolhapur-Nagpur Expressway, the company has entered into another concession agreement and all of that. Construction cost is 110 crores, fair value of construction cost is 200 crores and the agreement is a toll based project and the company needs to collect the toll from the user. So basically here the entity receives a right to what? A right to collect fee from the user. So there will be an intangible asset that would be created. Intangible asset would be created, right? Now when an intangible asset is being created, like we have done in the previous question, here also you will have to account for intangible asset. So for construction cost incurred, construction cost account debit 110, I think that is what the question says. Yeah, 110 crores to bank 110 crores. Okay, construction cost to bank 110 crores. Now, the fair value of the construction cost is 200 crores. So, you will recognize revenue by 200 crores. Sir, why revenue by 200 crores? Again, I am repeating. You have created an asset. You are transferring the control of that asset to the government and in exchange for that, you are receiving an intangible asset which is a non-monetary consideration. So, the revenue will be recognized at fair value of the services that are being provided. So, construction cost has a fair value of 200. So, you will recognize revenue of 200 and you will recognize an intangible asset of 200. So, intangible asset debit to revenue 200, right? So, that is the first thing. Then, as and when you collect the amount from the users, you will recognize revenue for that. So, bank account debit to revenue. Now, this is revenue from toll operations. Okay, amount is not given. So, whatever is the amount that is collected from the users, that will be debited to bank and that will be credited to revenue. That is the second thing. Then, will there be any finance income here? There will be no finance income here because as and when you collect toll from the users, you are recognizing revenue. So, there is no question of financing component. Then, what do we do with this intangible asset? This has to be amortized. So, amortization expense debit to intangible. How much? 200, 200. This will be over the period of toll operations. Okay, so over the period of toll operations, you will amortize it. Let us say the toll operation is 5 years. Then over a period of 5 years, you will recognize 40, 40, 40 as amortization expense. So you have revenue being recognized twice. One, when the constructed asset or the contract asset is transferred to the grantor, you have recognized revenue, and correspondingly you have received an intangible asset for that. That is the first thing. And this intangible asset, you will amortize it over the period of toll operations, and as you collect fee from the toll users, you will recognize revenue for that. So here you are actually recognizing revenue once here and once here. That is one thing you have to be careful when there is an intangible asset versus when there was a financial asset.